Hello and welcome back to our channel where you can learn everything new about finance. You'll probably get 5 different responses if you ask 5 people what a tax loophole is. Is this a tax break? Okay, sort of, just not in the way you would think. Is there a way to save money for taxpayers by using a loophole? When they can use them and whether they qualify almost always. Will the government be able to profit from it? No, and therein lies the issue. A tax loophole is a provision that makes the government lose revenue. Many people associate loopholes with companies in the corporate world, but there are a number of them open to individual taxpayers as well. They're perfectly legal. They're just tiny, intriguing loopholes in the tax code. Stuff that seems black and white on the surface but makes you go, when you look closer. It's up to you as a taxpayer to figure out what they are and how to use them. The Internal Revenue Service would not poke you on the shoulder and say, "Psst, take a look at how much money you'll save in taxes if you use this provision." Here are a few common tax pitfalls that you should be aware of. Before we get into it, please make sure you subscribe to our channel and like this video. Don't forget to hit the notification bell so you stay updated with new content. And let's get started. The capital gains tax rate. Capital gains tax is what you must pay when you sell an asset for more than your basis in it. What you paid for it plus certain expenses that contributed to its improvement or the sale. The difference between the selling point and your basis is your benefit, which you must disclose on Form 1040. So why is this regarded as a flaw? Isn't that something that you have to pay for? Yes, but the capital gains tax rate is lower than the rate of ordinary income taxation. You can pay less in taxes if you receive the majority or even a portion of your income from savings rather than from jobs or self-employment. For the vast majority of taxpayers, the capital gains premium on most long-term gains is just 15%. Compare that to what someone with an ordinary income of $80,000 will pay in 2020. 22% or a significant 7% more. So if you have a talent and finesse, you could buy and sell almost any type of property for a living while paying less in taxes than you would if you worked in a conventional job. From 2011 to 2015, the Joint Committee on Taxation reports that this loophole cost the federal government $457 billion. The home mortgage interest deduction. From 2011 to 2015, the government spent an additional $464 billion on the home mortgage interest deduction. In the 2017 fiscal year alone, it cost around $66 billion. This is most likely why, when the House of Representatives and the Senate negotiated to finalize the Tax Cuts and Jobs Act in late 2017, the deduction was a key factor. While this loophole is open to anybody who pays a mortgage and wishes to itemize their deductions, it only benefits the rich. Since interest is calculated as a percentage of a sum financed, those who can afford the most opulent, most luxurious homes pay more in mortgage interest. As a result, taxpayers with large mortgages will subtract a large portion of their taxable profits, although this is not the case for lower income earners. If you purchase a home and claim the deduction, you could save $2,500 or more per year on your taxable income, but if all you can afford is a bungalow, you'll only save a few $100 per year. Meanwhile, the IRS is missing out on a significant amount of revenue from the richest taxpayers. They get a good tax break just for living in luxurious surroundings, which they will do anyway. Even if you live in a much more modest house, you'll always need a roof over your head, so owning a home rather than renting will help you save money on your taxes. Employer-paid health insurance benefits. Then there are the health care benefits provided by the employer. The federal government spent $150 billion in 2017 and $157 billion in 2018 on tax provisions for these benefits. They're compensation. In a way, they're a perk of your job. After all, you'd have to pay for these benefits if your employer didn't provide them, right? However, there is a catch. You don't have to pay any taxes to them. You are not required to report their value as profits. That's right. Employer-provided insurance benefits are not taxable to the beneficiary according to the tax code. So, if you're looking for a job and the choice is between higher pay and no benefits or lower pay and benefits, you should seriously consider it. Those advantages are tax-free to you. 529 college savings plans. These plans are an excellent way to put money together for your children's education expenses. You can put money into this form of the college investment plan and have it grow tax-free thanks to Section 529 of the Federal Tax Code. If you're married, you and your partner will each make different donations for each of your children, which can add up to a lot of money over time. Since there is no federal cap to how much you can save, this is mostly a state tax loophole, although Section 529 of the Federal Tax Code does set many of the rules for these plans. The amount you can contribute per year is determined by each state. Let's say the cost of raising a child in your area is $4,000 per child. You and your partner each contribute $4,000 to Junior's college savings account. This would result in an $8,000 tax credit on your joint state return. That's good in any case, but remember this: you should make the donations on Monday and withdraw the funds for Junior's eligible education expenses on Tuesday. Take a look at what you've done. You've saved $8,000 in state taxes by first putting the money into a 529 college savings account rather than paying the school directly. The advantages of a home-based business. If you've ever considered starting your own company as a sole proprietor, you should think about the tax advantages while considering the risks. They include certain loopholes that might seem unfair to employed people, but which can be extremely useful to those who go it alone. Let's pretend Edna and John live right next door to each other. Their monthly mortgage payments are roughly the same, about $1,500, which includes principal, interest, taxes, and insurance. John is employed by someone else. He doesn't have an office at home. Edna works as a consultant on the side. Edna will subtract 15% of her mortgage interest, property taxes, and insurance premiums if 15% of her home square footage is devoted to her company. She also gets a discount on the principal portion of her mortgage, so she will depreciate that portion of the house. In addition, she will subtract 15% of her annual heating, electric, and water bills. She will subtract all she spends on office supplies, travel, car mileage, and ads, among other things. What does John end up with? He is given the opportunity to punch a time clock for someone else. With the passage of the Tax Cuts and Jobs Act in 2017, which abolished all deductions for employee work expenses from 2018 to 2025, he is no longer eligible for such a tax break as an employee. There are, of course, several accompanying laws. Edna is unable to do anything else in the 15% of her home where she lives. Her children are unable to watch television there, and her family is unable to eat there. She'll have to run her business out of that plate. However, if she meets any of these requirements, she will be able to take advantage of a lucrative tax break. The effect of the Tax Cuts and Jobs Act. Any of these loopholes are affected, at least in part, by the Tax Cuts and Jobs Act, which was passed in December 2017. The TCJA does not significantly affect capital gains taxes, but it does put a limit on the mortgage interest deduction. It applied to mortgages of up to $1 million until 2017. The sum has been reduced to $750,000. So, starting in 2018, if you have a $1 million mortgage, you can only subtract 75% of the annual interest you pay. However, in one of the earlier iterations of the tax bill that didn't pass, the cap was reduced to $500,000, giving taxpayers a small break. Under the TCJA, the loophole for 529 college savings plans got better. You may only withdraw funds tax-free to pay for college expenses until 2017. You can also withdraw up to $10,000 for high school or elementary school starting in 2018. Wall Street example of a loophole. If there's a loophole in the banking and finance world that requires huge amounts of money, you can rely on Wall Street and all those sharp lawyers and accountants to exploit it to the fullest and keep it running year after year. The carried interest clause, for example, enables private equity managers, venture capital investors, hedge fund managers, and real estate investors to pay a lower capital gains tax rate, currently 20%, on income received from their day-to-day job operation instead of the high higher ordinary income tax rate. This loophole has saved financiers like Steven Schwartzman, a public face of the private equity sector, and others like him hundreds of millions of dollars in taxes by generously supporting their patrons in Washington, especially if key leaders there happen to be from the real estate industry. A lucrative loophole can be thought of as a "you scratch my back, I'll scratch yours" deal for Wall Street. Tax laws change on a regular basis, so the above details might not be up to date. If you're thinking of making some changes, talk to a tax professional for the most up-to-date advice. The information in this video is not meant to be tax advice, and it should not be used as such. Thank you for watching the video until the end. Tell us in the comment section below your thoughts about today's video. Don't forget to activate the notification bell to stay updated on new finance content. Until next time.